Gold is at $2,847 an ounce, up 28% in the last 12 months, up 3.2% just this week, the moment the Iran war began. So the question everyone is asking right now is, should you buy gold? And if so, how much, what kind, and when do you sell? I am going to give you the complete, honest answer. No hype, no panic, just data. This is Wealth Realist. Before we answer the question, let's be clear on what gold actually is. Because most people get this wrong. Gold is not an investment in the traditional sense. It does not pay dividends. It does not grow like a business. Buying gold is buying insurance. For 3,000 years, longer than any stock market, longer than any currency, longer than any civilization, gold has been the final store of value. When everything else fails, gold holds. But here is the mistake most people make. They put too much in gold and not enough in growth assets. The right number is 5 to 15% of your portfolio. Not more. Never more. Now, the price. Gold is at $2,847 per ounce, as of this week. Let me give you some context. 1 year ago, up 28%. 5 years ago, up 62%. 20 years ago, gold was at $271 an ounce. Today, $2,847. That is a 950% increase over 20 years. And the dollar? The US dollar has lost 84% of its purchasing power since Nixon ended the gold standard in 1971. Gold does not lose value. Currencies do. Now, the 5 reasons you should consider buying gold right now, in March 2026. Reason 1. The geopolitical crisis. The U.S.-Iran war, Operation Epic Fury, launched on February 28th, oil at $89 per barrel. Strait of Hormuz closed. Markets in freefall. In every single geopolitical shock in history, money flows into gold. It happened in 1990 with the Gulf War. Gold surged 25%. It happened on 9/11. It happened in Ukraine 2022. And it is happening right now. Gold was already up 3.2% in the first week of this conflict. Reason 2, inflation is coming back. When oil prices jump 36%, that flows into the price of everything you buy. Goldman Sachs warned CPI could push above 4% this year. Here is what the data shows. When inflation is above 3%, gold historically outperforms every other major asset class. Stocks, bonds, real estate, gold beats them all in high inflation periods. During the 1970s inflation, gold rose 2,300%. From $35 an ounce to $850. We are seeing the same macro setup today. Reason 3, and this is the one that really gets my attention. Central banks around the world bought 1,037 tonnes of gold in 2023. That is the highest central bank gold buying in 55 years. The People's Bank of China, buying every single month. The Reserve Bank of India doubled its reserves. The National Bank of Poland, 100 tonnes added. These are not retail investors who panic. These are the most sophisticated financial institutions on earth. When they are buying this aggressively, you should pay attention. Reason 4, the US dollar is weakening. U.S. national debt now stands at $34.5 trillion. The federal deficit is $1.8 trillion per year and growing. More debt means more money printing. More printing means a weaker dollar. Here is the key relationship. Gold is priced in U.S. dollars. When the dollar weakens, gold price rises automatically. They move in opposite directions. They always have. The US dollar index has been trending lower since its 2022 peak. A weaker dollar is structurally bullish for gold. Reason 5. Portfolio diversification. This is a purely mathematical argument, and it is powerful. Gold has a near zero correlation to the stock market. Negative 0.02 to be precise. What that means, when stocks go down, gold does not necessarily go down with them. In 2008, the S&P 500 fell 38%. Gold fell only 2%. In 2020, COVID crash, stocks fell 35%. Gold rose 25% same year. A 5 to 10% gold allocation in your portfolio reduces your overall volatility dramatically. Now, how do you actually buy it? There are 4 methods. Let me walk you through each one honestly. Method 1, and my recommendation for most people, gold ETFs. An ETF is a fund that tracks the price of physical gold. You buy shares through any brokerage account, exactly like buying a stock. My top recommendations. Geldium, SPDR Gold Mini Shares. Fee, just 0.1% per year. This is the lowest cost option. IOW iShares Gold Trust. Fee, 0.25% per year. Geld, the original gold ETF, higher cost but highest liquidity. No storage required, no insurance, fully liquid, sell anytime. You can invest as little as $1. For 90% of investors, this is the right choice. Method 2, physical gold. Bars, coins, and bullion. You hold it, you own it completely. Nobody can freeze it. Nobody can hack it. The pros are real. True physical ownership passes to heirs easily. And completely private. The cons are also real. You must store it securely, either in a home safe or a vault. You need to insure it. And you pay a premium above the spot price when buying. If you go this route, use APMEX, JM Bullion, or SD Bullion. Always compare premiums before buying. Start with gold American Eagles or gold Maple Leafs, the most liquid coins to sell later. Method 3, gold mining stocks through the GDX ETF. This gives you amplified exposure. Miners can rise 2 to 3 times, more than gold itself. But they can also fall much harder. This is for experienced investors only. Method 4, gold futures contracts. Do not do this unless you are a professional trader. Futures use leverage. You can lose more than you invest. My recommendation, stick with GLEDM or EOO until you have at least 3 years of investing experience. Let's talk allocation. How much should you actually hold? If you are aggressive, age 20 to 35, growth focus. 3 to 5%. Small hedge. Let your growth assets work. If you are moderate, age 35 to 50. 5 to 10%. This is the standard allocation most advisors recommend. If you are conservative, age 50 and above, 10 to 15%. Protection becomes more important near retirement. Right now, during an active geopolitical crisis, you might temporarily go up to 15%, but reduce back when the crisis resolves. And the hard rule? Never put more than 20% in gold. Too much gold means sacrificing too much growth. When should you sell your gold? Sell signal 1, the crisis resolves. If the Strait of Hormuz reopens and oil falls back below $70, reduce your tactical position. Sell signal 2, inflation falls back. If CPI drops below 2.5% and the Fed cuts rates aggressively, gold loses its tailwind. But your long-term 5 to 10% core position? Keep it. Do not try to time the market. Think of it like car insurance. You do not cancel your car insurance because you have not crashed recently. Let me show you the 50-year track record, what gold actually did in every major crisis. 1971, Nixon ends the gold standard. Gold, $35 an ounce. By 1980, $850. 2,300% return in 9 years. 1990, Gulf War. Gold surged 25% in 3 months. 2001, 9/11 and the dot-com crash. Stocks fell 38%. Gold eventually rose 65%. 2008, global financial crisis. S&P fell 38%. Gold fell only 2%. 2020, COVID, stocks crashed 35%. Gold rose 25%. Same year, 2026, Iran war. Gold up 3.2% in week 1. The pattern is consistent. It has never failed. So, should you buy gold right now? Yes, if you currently have 0 gold in your portfolio. Yes, if you are worried about inflation staying elevated. Yes, if you want crisis protection for the next 6 to 12 months. Maybe, if you already have 5 to 10%, you might add slightly. No, if you need this money within 6 months. That belongs in a high-yield savings account. No, if you have no emergency fund yet. Build that first. The short answer? Yes. 5 to 10%. Use GLIM or OW. Buy it today. If this was useful, please subscribe. New videos every Monday, Wednesday, and Friday. Next video, is your 401k safe during a war? And my free guide is at everydaycalculators.com/free guide. Stay calm. Stay informed. This is Wealth Realist.